Hey folks, hope you're all doing well. Welcome back to the channel where we try to find opportunities to make money in the markets. And a few months ago, you might remember that I put out this video called The Most Undervalued Small Cap Stocks in 2022. That was posted in October of last year, where I basically highlighted 5 different small cap stocks that I thought were undervalued and how have these stocks performed since I put out that video. Well, Century Communities is up about 25%. Addis Home Care is down by about 4%. Malibu Boats from the Friday close of October 21st to now is up about 17%, positive 4% for ArcBest. And finally, Semtech Corporation is up about 14%. So other than Addis Home Care, all the stocks are up. And if someone had put an equal weighting into all of these stocks at the time I highlighted them, that portfolio of these 5 stocks would be up about 11.2%. And by comparison, if we look at the S&P 500, that's only up about 5%. So one of the advantages of these smaller cap stocks is they tend to move more than larger caps. So if the overall market moves up, then you would expect smaller cap companies to do well. And if you have a handful of them, then you diversify the risk across multiple companies. So that's a good way to invest in a bear market because, as I mentioned in the previous video, small cap stocks are trading at a lower valuation than large cap, which means they have a lot more upside than downside when you compare it to the S&P 500 index. Now, we're still in a bear market, and the stock market still could fall further from here because we've been in this bear channel for over a year now, and we haven't broken out of it. But my overall thesis of buying smaller cap companies in this bear market still holds because if you have a longer time horizon, then eventually when the market picks back up, the smaller cap stocks, since they're starting from a lower valuation, will tend to outperform the larger cap companies. Of course, you can't just randomly pick any small cap stock, which is why it's really important to pick the ones with a strong balance sheet, fast growth, high quality, and they can withstand a recession because a company can't grow if it goes bankrupt first. So in that last video I posted in October, I talked about 5 undervalued stocks that were of high quality, and in today's video I will highlight 3 more undervalued small cap stocks that I think are worth paying attention to. The first one is ACM Research, ticker ACMR, currently trading at $9.55. They basically produce cleaning equipment for semiconductor wafers. So they're not directly making chips, but they're more like working on the support system around the semiconductor industry. As usual, one of the first things I always look at is the company growing or not? Looking at their revenues per share. It looks like over the last few years, it has been growing. And it's important to look at the per share number instead of just the revenue. Because from 2016 to 2021, you can see the revenue grew by almost 10 times from 27 million to 260. However, they only had 15 million shares back in 2016, and that increased to 55 million. So on a per share basis, the revenue growth has not been that dramatic. I mean, it's still pretty good though, which is really nice to see. But that's why you want to look at the revenues per share, also earnings per share, all those numbers like that on a per share basis, because with fast growing companies like this, they do tend to dilute the shareholder over time. Return on invested capital is another number I like to look at. It looks like this is right now in the mid single digits. Hopefully they can get it back up to low double digits over time. Now, based on the growth projection of this company, the future seems to look pretty bright. This year, they are growing by 21%. Next year, a little bit slower. However, over the next 5 years, analysts are expecting a 42.7% annual growth rate. So I don't know if they'll actually get it to that high, but over the last 5 years, they're able to get nearly 40% per year in growth. So you would expect a company like this to have a fairly high PE, but it's only at 14.92. Looking back at ROIC here, 14.92 is the current PE, but the forward PE is 11. And you want to see the forward PE lower than the current PE because that's how you know the company is growing. But what really got my attention for this company, if I go to statistics here in Yahoo Finance, is when you look at the price to book, it's only at 0.88. This is less than 1. That means this is trading below its liquidation value. Looking at the valuation from a price to sales ratio, you can see it's down all the way in the gutter here at just 1.3. So that is historically cheap if you compare it to the last 5 years. And finally, Morningstar Research has a fair value for this company at $23 per share, while it's currently at 9.55. So you're looking at a 150% price appreciation potentially for this stock. So how would I go about buying a stock like this? Well, looking at the history of the price chart, it looks like similar to many growth stocks, after 2020, it had this huge run up followed by this massive drop back down to basically where it was. And you have this symmetrical pyramid shape in the chart. And right now we're basically back at where the stock should be had it just continued to grow at a normal pace and the pandemic never happened. So if we take a look at this trend here, we can basically see that this blue line that I've drawn almost acts as a support that the stock bounces off of every time it reaches this line. It even tried to go under here back in October during the lows of the stock market, but it looked like it did not fall too much below before coming right back up. So in the short term, it looks like it is forming sort of a bullish trading range because we've seen it test the lows 1, 2, 3 times. That's like a soft touch before bouncing up. And then on the top here, we also have a couple of touches, one over here, one over here. Because the most recent touch was on the bottom, I would expect it to come back up and touch the top here. But basically, it's within this range that is going up. So that is bullish. And the way I would buy the stock right now is basically dollar cost average in. So it's at about $9.50 right now. If I want to say put $1,000 into this stock, I would probably buy like $100 right now, which is like 10 shares. And then I would wait and see if it continues going up this channel. So if it continues to go up and down here over the next couple of months, then I would try to buy more when it gets to the bottom of this range here. Maybe adding like 10 or 20 more shares when it does that. Because this stock is profitable, actually all 3 stocks that I'm going to be talking about today are profitable. But because it is making money, there's a very good chance that this blue support line will hold and the stock will continue to go up from here. Now, the next undervalued stock that I think is interesting to look at is Brilliant Earth Group. The ticker is BRLT. And this is currently trading at $4.15. The company basically designs and sells diamonds and jewelry. Revenue is growing at a pretty good clip from 24 to 30 to 45 over the last few years. EPS growth is also pretty good. There aren't a lot of analysts covering this. There are only 3, but the most bearish analyst is giving this a price target of 6. So that's already like nearly a 50% increase from the price today. And then the average price is 7.5. So you're looking at an 80% potential upside there. Over the years, the company has been growing its profits at a very nice rate. They have about $172 million of cash, and the company is cash flow positive. In 2019, they barely broke even, but then they had 26 million in free cash flow the next year, and in 2021 they made $40 million in free cash flow. So very solvent company, and they're growing. During the last couple of years, the stock did reach as high as $20 per share, but now it's dropped down to 4. So that is quite a large drop from the top. Now, because the financials of this company is looking pretty strong, and it looks like they can continue to grow their top line and bottom line over time, I think there's a lot of potential for this stock to go much higher in the future. Now, how would I go about investing or buying a stock like this? So to me, looking at the chart, this is more of a trading stock than a buy and hold type of stock. So what I mean by that is if I'm thinking about investing in this company, I am going to buy this with the intention that at some point in the future, I'm probably going to have to sell it because the valuations at that time would not make sense. Right now, it's looking pretty cheap. It's trading at 21 times PE, which is historically low for this company. We can take a look at the Refinitiv stock report here. So about 20 PE right now, but the 5-year average is 72. And the forward PE is only 13 because the earnings are expected to grow next year. So paying 13 times for next year's earnings is not expensive for this stock. But at some point, if it reaches like 12 or 14 or some very high number, then I'll probably start to think about trimming my position and taking some profits. So the way I would play this is pick a bottom where I think there's strong support, and then pick a resistance where I think I might want to sell part of my position. So it looks like down here around $4 is going to be a nice support because we sort of of see this double bottom here when the stock went just below $4 here, and also over here just below $4. The sellers have tried to push the stock down past this point, and they failed 2 times. So a lot of them are just giving up. And when that happens, the buyers come in, and then we tend to see a bounce. So over the next couple of weeks or months, I would expect the stock to move higher and maybe like fill these gaps over here. Now, there's always the chance that that does not happen, in which case you want to set like a stop loss. So I would probably set my stop loss down around maybe the $3 range. So if the stock were to fall, let's say I put in a limit order at $4, which is not far from where the stock is today, and it falls down to $3, well, then I would get out of my position, because at that point there is no historical precedent of where the bottom might be. So it could fall to $2 or $1. It's hard to say. But if the stock does move up after this double bottom, then I would expect the next point it would hit is this top over here at about 930, because that's where the stock met resistance during the previous run where it tried to push higher, right? So basically the most I can lose is $1 on the downside from $4 to $3, but the most I can make, maybe even more if I only sell a part of my position if the stock moves up there, is like $5.40. So that's a nice risk to reward ratio that I'm willing to bet on. And maybe it will move down past below 4 again, but it might go to like 3.5, find a bottom there, and then head up. So that would be a good outcome as well if I were to buy in at $4. Now, the final stock that I think is interesting to look at is car parts. And they basically do what their name says, carparts.com. They sell aftermarket auto parts online in the US and the Philippines. They are a fast growing company, growing 90% this year. Next year is expected to grow at 200%, but then over the next 5 years, just 15% per year, which is still a pretty good speed. There are 2 analysts covering this stock. One gives it $9, the other gives it a $10 price target. And the stock is currently trading at $6.51. And there's a couple of things that stood out to me about this company. One thing is that it's been around for a long time. On the ROIC website, the data goes all the way back to 2006. Now, the growth hasn't been that strong, but it is steady most of the time. Looking at the Morningstar report here, it's interesting that the fair value it gives it is about twice as much as the current price. And why this is significant is that most of the time, the two tends to track each other pretty closely. You can see with this graph, it was just recently in 2022 where we see this noticeable divergence in what the fair value should be and where the actual price is. That's happened kind of before in 2018, 2019, but not to the extent that it's happening right now. So either this red line, the fair value, has to move down, or the black line, the actual price, needs to go up so the two will converge again. And right now it looks kind of like they're sort of doing a little bit of both. But even if the stock price moves up just a little bit, that's going to give you a positive return with this. So it's currently at a price to fair value of just 0.5, but historically, rarely does it go down this low. Back in 2018, it was at 0.56, but you can see that was near the lows of the market, and eventually the stock, not only the stock went up, but also the fair value, the red line, went up as well, and eventually they did meet up again. So as with all stocks, and especially with smaller cap stocks in general, you do have to sort of be a little bit patient with these companies. So don't expect like a big rally over the next quarter or so. You might have to wait a couple of years for things to play out. The other thing that caught my attention is the fact that insiders have been buying shares of this company. Just a couple of months ago in November and last month in December, we had the CFO as well as a director purchase quite a lot of shares. And even before then, during the summer months, you had a bunch of directors also purchasing shares. Throughout 2022, when the stock market was going down, and of course, this company was dropping as well from $12 to where it is now. But during that time, executives of the company were, for the most part, buying the stock instead of selling it. So that shows that people at the company have confidence that their stock is undervalued and there's potentially a lot of value that they can realize in the future. So how would I go about buying a stock like this? So it looks like there's a pretty strong support line around here. It used to be resistance back here in 2016, but then it went through that pretty aggressively, came back down, reached that point again, but this time as support, and then there was a bounce up. So what I'd probably do for this one is just buy a little bit now, but really wait and see if it goes back to this 450 range down here. Because right now we're seeing lower lows, right? This is a lower low than this one, and we're seeing lower highs. This is a lower high than this one. So there's a good chance the stock will move up and then down, and if it drops below this 450, then I would probably not buy again until it comes back up, bounces off of this 450 line and continues to go up. I would probably buy somewhere around there. Now if this just continues to go up, then I would just be continuing to buy, but this 450 seems to be a pretty important level to watch for. So those are 3 different small cap stocks that I think are interesting to look at right now, and how I would go about buying them. Of course, none of this is financial advice, and everyone should do their own research before buying any stock. And just remember to look at quality and cash flow and clean balance sheets so that you don't pick stocks that look cheap, but eventually they might go to zero. The 5 stocks that I mentioned in the previous video from October, all of those theses are still intact. We may be facing a recession this year, but longer term, these are still good companies to consider investing in. So if you missed that video and you're wondering why I picked those 5 stocks or what I like about them, you can watch that video over here. Anyway, thanks a lot for watching. Good luck with your investments, and I'll talk to you in the next one.